Now I'd like to introduce our next panel, which is the US upstream revolution, its global impact, and its future, and turn over to the moderator, Casey Sattler, who is the news editor, Western Hemisphere, with Energy Intelligence. Thank you.
All right. Thank you very much, Peter. Well, let's all be honest. We can't have a discussion today about the boom and bust that we've seen the past couple years without talking about US shale. It's not that we haven't talked about it at various points so far today, but the idea with this panel is really to dive into how this market is responding and the lessons moving forward. We all know the story of this transformative resource up to this point. It's the resource that produced next to nothing a decade ago, but one whose unanticipated rise amid $100 oil helped flood a market that was no longer accustomed to seeing such volumes come online with such speed. But as impressive as this story is, what the industry must come to grips with today is not how or why it got here, but where it is that it is going. The US tight oil story has been full of surprises to date, but what I hope we can do in the next 45 minutes is discuss with these gentlemen what they have learned about this sector and how it is framing their view of what is to come. So to my immediate right, I am joined by Mario Ruscev, Chief Technology Officer of oilfield services giant Weatherford International. To his right is Scott Sheffield, Chairman and CEO of Pioneer Natural Resources, one of the largest tight oil producers in the US. And last but not least, to his right is Lorenzo Simonelli, President and CEO of GE Oil and Gas. US oil prices have fallen about 57% since mid-2014. Yet what did US tight oil do? It kept rising another 18% before finally turning over in May of last year and is now down more than 700,000 barrels a day. Generally speaking, the reason for this is that while the number of rigs operating in the US onshore has fallen rapidly alongside crude, the industry's productivity has soared and costs have tumbled. So with that as our starting point, there seems to be a debate of sorts brewing between service companies and upstream operators around how much of these efficiency gains and cost savings can really be sustainable in a rising price environment. So, Scott, not to put you in the hot seat between two oil services executives to start, but in your view, how much of what we have seen can be attributed to a smarter, more sophisticated shale business, and how much is just cost deflation in a low price environment?
Yes, Casey, and thank you for the invitation to be here, Energy Intelligence. But when you looked at our modeling in 2014 at Pioneer, I thought we all knew service companies were going to cut their cost like they have in all past cycles, thanks to Mario and Lorenzo. But what has transpired has been more amazing because we did not think we could make money at $40, $45, $50 oil in the Permian Basin back in 2014. And so there's other things that we have done to get very efficient. We're drilling our wells in half the amount of time. We're completing our wells much quicker. We've changed the way we complete our wells. Instead of trying to get frac height, we're trying to break up all the rock nearest the well bore. And so we're getting 40, 50% more increases in our well productivity. And that's why when you look at the Permian Basin, it has stayed flat. So if you look at what declined, it's been the Eagle Ford and the Bakken. They're down 1 million barrels a day. The Permian has been flat, and that's going from 560 rigs to 130 rigs. And now you've had an increase in rig activity in the Permian Basin, and we'll start seeing Permian grow from 2 million barrels a day, probably at least 300,000 barrels a day, starting in 2017. Another big factor is the Permian companies. I know, starting with hopefully following Pioneer's learnings from the last 6 down cycles, is you got to go into this downturn with a great balance sheet. And so if you look at all the balance sheets, John Hess talked about the balance sheets. All the Permian companies in general had essentially very little debt on their balance sheet. Small independents are growing 40 to 50%. Pioneer's been growing the Permian 25 to 30% during this downturn. So we're still growing because you can get a great return at $40 oil, 45, 50. And I think people heard me get quoted in Stavanger at the ONS conference that our break-even price is below $30 a barrel, which is amazing to me. So.
Well, Mario and then Lorenzo, from your vantage point, how do you see this balance?
Well, we have to remember that actually, even in the Permian, all oil service companies lose money. So it's true that the actual price cannot be sustainable long term. And we did cut a lot, I can assure you, we cut to the bone, so it's not a question. Now, and then if you look at the global thing, you have to realize that the service industry has put a huge investment into the shale in the time when oil was at 100 and everybody believed that it will stay like that forever. Now, if you have to restart the activity, we just restarted a couple of crews in the Permian. We have the equipment, so we need to go to hire people. We need to hire about 300 people. We fired thousands before, so we thought, let's go to the good guys we fired. The success ratio was about 20%. 80% of them said, forget it, I'm not going back to this business. Because we fired thousands, we still have some margin, which will probably go south probably in a couple of quarters. Now the big issue is we still have equipment for a while, but probably sometime in 2017, mid or late 2017, if there is really a takeoff, we'll have to start putting capex again. And this time, nobody can believe that it will stay like that forever, which means that if I have to give capex, I need to make sure that I can get this money back, which is not a 6 months contract at some price, because we don't depreciate that over 6 months. And I think it will put quite some pressure on the way we restart. So, yeah, there is life and future in the shale, and I'm not speaking only of Permian, all general, but it will be different from, it will be different from what it was before. And when people believe that we can just switch it on, I think it's, I don't see it that way.
So I think what we've seen is that there's clearly efficiency that's going to be maintained, some that's going to change. But what's interesting about this industry is technology always comes along to help. And what we've seen is really 3 phases during this cycle, and I think we'll see it evolve as we go forward. The first phase was, just go after deflation. And that's where you see the service companies give up their margin and, to Mario's point, in some cases lose money. But then also the service companies and the equipment providers, in collaboration with the operators, start to standardize products, start to look at efficiencies that we can obtain together within the production process. And then you move into a third phase, which is how do you adopt new technologies, multi-pad drilling? How do you utilize data to provide efficiencies from a well perspective? So when you think of wells that used to be $90 break even, that break even has come down, and we're going to be able to maintain that break even. And I think our role from a service provider perspective is really to assist the operators in maintaining that. And we think the real solution is through productivity and the usage of data. As we move into the 4th phase of the Industrial Revolution, there is still a tremendous amount of waste in this industry. When you look at the drilling of a well, there's still 50% of time that's waste. So how do we go after that to actually provide efficiencies in the integration of these processes? And hand in hand, we've got to make sure we do that as we go into a stage that's going to demand even more efficiencies.
Well, I definitely want to get back on a couple of the points you raised, but Scott, I did want to ask you a question before we move on. And as a tight oil that has continued to grow during the downturn and is looking to hit the accelerator when prices cooperate, do you have any concerns about constraints on the services side, and how do you try to manage them?
Yes, we are concerned. Like, for instance, the Permian is set up. We've added 70 rigs already in the Permian. Pioneer is in the process of adding 5. We have a long-term model of adding roughly 5 to 6 per year over the next several years. And so I've said that we could easily add another 100 rigs in the Permian, which will put it up, over 300 rigs. And So we're concerned about whether or not the service companies can get the people back because they all left the industry. So we are concerned about that. And we're concerned down the road of the Permian growing too much. And so we're going to need additional pipelines. It'll be tight in 2018-19 in regard to getting crude oil to the Gulf Coast. And so if we grow 300,000 barrels a day every year, we're going to need a new pipeline to the Gulf Coast essentially every year. And so that's one of my long-term concerns. Waha is being expanded. Most people don't realize the Permian is the second largest gas producer in the United States. Nobody talks about it. And it's all associated gas we don't really care about. We do care about it, but it covers our operating costs. But it's producing 7 BCF a day, and it's projected to get on up to 15 BCF a day, with the Marcellus and Utica being the largest. And most of that gas will be going to Mexico. So a lot of infrastructure has to be built going from Waha to Mexico to deliver that gas. Lastly, probably some of the EPA recent rulings in regard to, they're looking at stricter and stricter on methane emissions. We're all for doing everything we can in the environment as a company, but they're getting to a point where they propose to we have to put maybe vapor recovery units on every marginal well in the U.S., and that would take about 1 million barrels a day potentially off the market. So we're concerned about some of the stricter EPA rules that could come down with Obama that have been proposed. They'll move into most likely a Clinton administration. So that will continue, so we're concerned about some of that. One last thing about water, just to brag about it. West Texas is very dry. It rains about 3 inches a year, maybe as much as 4. Annual rainfall. So Pioneer set a goal to not use fresh water at some point in time. And so we're actually using wastewater from the cities of Odessa and eventually cities of Midland. So we're using the treated wastewater, and that's what we frack with. And so we hope to be, with that and a non-potable water source, move totally away from fresh water. So.
Nice. Well, I want to circle back on kind of the role of technology and start with you, Mario. I mean, I know one of the things that Weatherford and some of your peers have really tried to establish in recent years is this notion of holistic development of shale. You know, that there is certainly a benefit to kind of a lean manufacturing approach, but at the same time that investing in the science, the advanced seismic and the reservoir modeling and that kind of thing can also reap tremendous benefits. And so I'm wondering how you're seeing the industry's view of these advanced technologies evolve in shale, and what do you think it's added to the industry's understanding of it as a resource?
Well, you know, a few years ago, one of the companies that did most of the production logging measurement after fracked announced that because we had access to the data, that basically at least 40% of what we frack is not producing. You know, if you look for an efficiency, that would be a big inefficiency. And in fact, the reality to solve that and to frack selectively is not that very complicated. It is true that up to now, you know, a few years ago in the boom, if you go to ask that to a customer, he told you, well, listen, I have 200 wells to drill. Why don't we speak about it later? So it was not the right time. Now that everybody is recovering, we still see people doing mostly pure brute force, you know. Bigger wells, more sand, more recovery. But at some time, as we need to bring more of it, and we cannot have just a few of a really nice spots that operate at 50. I think some of these things will have to come into practice. So we really believe that, yeah, one of the future of shale is becoming more. Now remember, we produce a lot, but as a physicist, you know, we use terminology like recovery factor, Darcy law, which is totally irrelevant in a micro-Darcy environment. It's a whole new world we have to reinvent and state a new one. And basically, we need to understand, you know, when we create these frac networks by which we create, we are not really able to simulate it now. We believe we are, but in reality, we have a lot of difficulties. There is a huge amount of uncertainty into that. So when we can master all of that, I think we'll become much more efficient. And more than drilling faster, I think this will bring an even more. You know, I would like to be able to, remember, most of the cost of a well is completion. And knowing that 40% of his completion most of the time is not used is a huge waste. What we want is every frac should produce, and I think we'll be there.
Well, Lorenzo, I was wondering if you could kind of expand upon your comments about big data and just the role of technology in improving kind of the overall uptime and reliability, and how that can also have tremendous gains in terms of improving the economics of shale.
I think if you look at breaking it down, when you look at the value chain of drilling a well and actually getting to the completion and the production, there's going to be the day where you can actually take a wing-to-wing approach and associate all of the data that's from the equipment side, the reservoir, also the amount of gas versus liquid, water cut versus the oil being produced, and then actually get to a model where you're simulating how do you maximize production. And that day is here already. When you look at being able to have all of this information and data captured, you've got the sensors that are available on the drill bits. You've got the capability of seeing the cuts from the meters on the surface side. So now we need to move to a world where we're actually creating that digital twin, is the way we reference it, but it's gathering all of that information and then being able to make the algorithms so that you maximize production. I'll give you an example of just utilization of an ESP or a rod lift system. Just by simply understanding the reservoir, the data that's available, understanding the way in which you're utilizing energy and also the water and oil cut, you're able to work with the ESP or the rod lift system to maximize the production of that well. And we've seen increases of 2 to 5% just by algorithmically looking at that information. So you've got the production increases. Then you've also got the element of eliminating downtime. One of the key reasons why we're not producing is because the piece of equipment isn't working. So how do we maximize the uptime of that piece of equipment? And again, by being able to look at the vibration on an ESP or a motor, you're now able to anticipate before an event takes place, which puts you out of production. A well out of production for a week is still millions of dollars of lost production. We can anticipate those now today. At GE, we call it Predix, our industrial operating system, and then we've got applications that we build upon Predix. But that's where we're evolving to, and I think as an industry overall, we're seeing a number of advantages by capturing the data.
Well, Scott, from your perspective as an operator who's looking at these advanced technologies, where do you see the investment worth it, and what kinds of offerings that are starting to come out or you're seeing in the field excite you?
Yeah, I think one of the things what Mario was saying about not knowing where our fracs are, I think by moving, I didn't add to it, but we're adding more stages, reducing the clusters from 60 feet down to 10 to 15 feet. And so we're basically, in our opinion, breaking up all rock nearest the wellbore because we're doing more stages. I think John Hess said they're going from 35 to 50 this morning. We're doing the same thing in the Permian. And so, in my opinion, we're breaking up more and more rock. Also in the U.S., we do have some legal issues to be concerned about. We don't want data because we are crossing 3 to 4 sets of royalty owners. So we're taking our laterals out 14,000 feet now. And so we're crossing 3 or 4 different areas of different royalty owners. And so we're allocating the production based on perforated frac length. So our entire perforated interval. And so let's say it's a third. So at the end of the day, we don't want to know where the production's coming from.
They don't want to
Obviously,
know.
But that's one of the issues about having private mineral ownership in the U.S. So we're setting new precedents. So
fair enough.
Now you know why they don't want to run
right.
Easy logs.
Sometimes ignorance is bliss. Well, I mean, if we look at shale development more broadly internationally, it's honestly been somewhat of a dud outside of Argentina and perhaps China. But at the same time, it's also been several years since a lot of those initial exploration attempts were done. And so I'm curious, given the rapid learning curve that we've seen in U.S. and the applications of technology that have been more effective, do you see an advantage in going back and trying again, or could it perhaps help a Mexico or a Saudi Arabia that's looking at it in the future, expedite their process? Mario, if you want to start.
Well, the last example you told, remember this morning somebody said you need five factors to make it happen. And and I think he was right. Most of the issues was not about the rocks. It was about, let's call it politics altogether, or human factors, which are nothing to do with geology. And so why going back to these places as long as these factors are do not get better? Like I said, Argentina, probably, one day when the reef stops between Russians and the other, the Bazhenov will be huge, because you have an infrastructure, you have the rocks, you have everything. This is probably one of the biggest potential. But it's not about geology, at least.
I think the other aspect which is unique in the United States is also the land rights, which you don't necessarily have in other countries. When you look at the opportunity, Argentina clearly has an opportunity when the infrastructure gets developed, and they are working towards that. China, again, an opportunity. They lack the water at the moment. But I think what's said already by Mario is very true. It's not so much the rocks, it's more the infrastructure and then the regulatory. You look at where we are today in the United Kingdom, there's opportunities to have gas, and from a regulation perspective, though, it's very complicated. So.
Well, that's very fair. Well, I mean, one way shale has clearly still had an impact globally is the amount of supply that we've seen out of the U.S. And I'm curious, Scott, moving forward, do you see U.S. tight oil being as disruptive as we saw before the downturn, when it was growing 1 million barrels a day year after year? Can we get back to that level of growth? Should the industry try for it? Is it sustainable, or how do you see it moving forward?
Yeah, you see the Permian moving now. So the Permian's going to show, it won't show production growth. It's flat at 2 million barrels a day over the last 2.5 years. And so as it was starting to grow, the downturn hit, the rig count fell, and now the rig count's moved back up to 200 rigs. And we'll see that production the first half of 17. And then you get another 100 rig add. And that can all happen around $50. So at $50, Permian will grow 300,000. In my opinion, Eagle Ford and Bakken will start slowing their declines and could flatten. At 55 to 60, you'll see people add rigs to the Eagle Ford and the Bakken. The plays in Oklahoma are growing now, so there's more rigs in Oklahoma in the Stack and Scoop play than there is in the Bakken and the Eagle Ford. So at 55 to 60, you'll start seeing the Eagle Ford and Bakken take off. At that point in time, at $60 oil, I think you could easily add 700,000 barrels a day if you give them 12 to 18 months past that. So you got to see 60, you got to see it stable. And my opinion is, nobody talked about it in the previous commodities trading, but I think my opinion is oil is going to go into backwardation. So if crude moves up towards 60, 65, I think crude will go into backwardation for a while. And so that's going to keep people from adding a lot of rigs. It's not just going to be a flat curve at 60, 65 for the next 7 years. That's my opinion. That'll slow things down from getting out of hand. So I don't think you'll get into the 600, 700, 800,000 barrel numbers until probably late 2019. The world may need it based on some of the comments this morning.
Yes, that makes a lot of sense. I want to shift gears a bit to U.S. shale gas and maybe some of the lessons that can be drawn from the companies that stuck with gas even when prices turned, rather than shifting to oil. We've seen some consolidation. We've seen a tremendous amount of efficiency to the point where a $3 gas price that a couple years ago would have been fairly devastating is somewhat of a godsend. It's not perfect. It doesn't allow growth, but it's still, there's been just a tremendous amount of improvement. Are there lessons that the tight oil sector can take from that experience? I'll open it to the floor.
I mean, it comes down to the efficiency factor, and again, applying new technologies, applying new processes. As you look at gas, gas is the one resource that is going to continue to grow from a usage perspective. The macro theme of the population requiring energy hasn't shifted. The element that power generation is going to shift more to gas hasn't shifted. The opportunity for LNG to continue to increase hasn't shifted. So if anything, even though there is a big abundance of gas, gas is the resource that's going to grow the fastest over the course of the next 15 years, is our belief. And they've proven their resilience. And it's good to have cheap gas because it will drive the energy prices low.
But, you know, we speak about up to now in the US shales, whether it's gas or oil, we have done huge gain in efficiency. We did not really evolve the technology, you know, frankly. We still, like you were saying, you know, now he crashed much more just to make sure he doesn't miss anything. This is a change of methodology, I would say. There is no new technology being used on it. The technology has been the same, you know. Like I say, if we start getting more, even we have been using analytics in the shales, but because we don't have so much data directly on the inhomogeneity of how it is, we use statistical ones. So, you know, you start getting good. I remember when I was discussing with guys that use it, after 100 wells, you start getting really nice results. Remember, 100 wells is anywhere between $500 million and $1 billion investment. So starting getting more efficient of $1 billion is still not the goal we want to achieve. So I think, but I agree with him. There is a huge amount of efficiency of that we can bring, or better results we can bring by technology. So.
Yeah, Casey, a couple of points on the gas is that what happened, people were making 10 to 20 million a day wells, and all of a sudden they started making 50 to 60 million a day wells in the Marcellus and the Utica. And that was the big change. And I tell people, our investors, they ask us the same question. If we start making 10,000 barrel a day wells, which is the energy equivalent, you need to short crude. So these new frac jobs in the Permian and other places, Bakken and Eagleford, what we're doing is the wells are increasing, but it's the ultimate decline curve that's getting better. It's flatter, so it's not falling off as fast as it used to. So the breakover point is much, much less with these new frac jobs. The second point is we're experiencing in the U.S., there's a movement to essentially go after all pipelines now. So the environmental groups, with their success of Keystone, are going after the Dakota pipeline. They went after Constitution. They're going after Atlantic Sunrise. And so their goal is to stop all the pipelines. And so the nice thing about the Permian, it's all in Texas. All we got to do is lay a pipeline from West Texas in Texas to the Gulf Coast. In the Northeast, you got to cross all these northeastern states. And these movements are stopping essentially a lot of the key pipelines, which is going to create a major crisis for the Northeast at some point in time.
Well, this may be your answer to the final question I want to ask before I open up to the floor, but it's this notion of, we know that there are many opportunities that lie ahead in shale, but what do you see as the biggest potential risk moving forward? And it really could be anything, you know, is it personnel, is it technical, is it political, you know, you name it, but I'd be curious on what your thoughts are. Mario, you want to start?
For me, it's political. There's no doubt that we'll get the shales, and whatever is the cost, we'll make money out of it. We'll find a way. I'll give you an example. We all know there is earthquakes in Oklahoma, much more than, there should not be, and they are. The guys in Stanford, Mike Zobach's team, found 2 years ago that we create it, you know, we inject. I mean, it's not fracking, by the way. It's other wells that produce a lot of water, which is re-injected, and somebody found a way to inject water into a reservoir which is just on top of faults. And if you pressurize the reservoir on top of faults, you'll create earthquakes. What has been the reaction of our industry to it? We need more studies, we need more proofs. You know, one day we'll have a big issue on our hands, and we're not very good at acting before it happens. You know, it's something which is very simple to solve. Just find somewhere we can inject which is not on top of faults. Every geophysicist will tell you it's easy. We know the faults. But we don't see, you know, 2 years after, we still are not reacting to it. And are we going to wait until something dramatic happens and we have to react? So I think, you know, I think in the book of Art of War, somebody was saying, we went in search of our enemy and we found it. It was ourselves. Somehow, sometimes I feel this way.
Fair enough. Scott, anything to add?
Yes,
to
I would say, I always say commodity prices, but I think the biggest issue out there, it was discussed at lunch, several speakers this morning, is crude oil demand. If crude oil demand ever starts slowing below 1 million barrels a day, and we start seeing it, then we're going to see everybody fighting for their livelihood throughout the world. So,
Fair enough. Lorenzo?
So I think just to add to political, but very specifically regulatory. And if you look at what's happening from a methane perspective, you look at the CO2, and then in particular water. We have to, as Scott mentioned, the way they're using wastewater, but across the industry, we're producing more water than we are oil, and we've got to make sure that we understand the consequences of that and how it's utilized. But across those three, CO2, methane, and water, there's going to be EPA requirements and also globally regulation coming in that we've got to be able to understand.
Very good. Well, with that, I'd like to open it up to the floor for questions.
Scott, you may have partially answered this, but I have a real smart friend who knows a lot. He's president of a refining company, but he thinks that the Permian will grow to 5 million barrels a day in 10 years. Now, you've said it's 2 now. That's a big jump. Do you think he's crazy, or is that possible?
he's getting the information from us.
He's heard some of your speeches.
No, we've modeled our own company over the next 10 years, and we can grow to about 1 million barrels a day in the Permian at $50 oil. And well, no, we can do it at 50, and it's 70% of that is oil. So we're at 700,000 barrels a day out of 1 million. And so when I look at all the companies that are out there, all the deals that are being done in the Midland Basin, the Delaware, the Permian could easily grow to 5 million barrels a day. Long term, it could probably get to 10 million barrels a day. It's a question of cash flow, equity, balance sheets, and the price of oil. The rock is there. There's 4,000 feet of shales. So we're only going after 3 zones now. There's another 9 zones that have been discovered. Apache just found the 12th zone, which we haven't. It turns out we have the zone below all of our zones. It's at the Woodford Barnett. There's no reason for us to go after it now, but Apache found 2 billion barrels in extreme West Texas, just in the Barnett Woodford. So there's lots of oil. It'll grow for a long period of time. It'll easily pass 5 million barrels a day. It's just a question of what pace.
Herman Franzen, EIG. I have a follow-up question on that. There is more of a limit, I think, on the resource base of tight oil than there is of shale gas. The question is, if you grow at this level, and then we get back to $60 oil, and you're going to produce 600,000 to 700,000 barrels a day more annually, most of it's probably Permian. As you say, the others are not going to be as productive. Then obviously, if you go to $70, the others will probably start picking up too. But how long can this be sustained? Given what we know now of the resource base, or is technology going to further improve this, have higher recovery rates ultimately, and you can extend it for decades to come? I have no idea about it, but I would be very interested in your opinion.
My point, the Permian we have over 20,000 locations. And so if you add up, the Permian is a 75 billion barrel discovery in the Spraberry Wolfcamp, recoverable. There's 40 billion in the Delaware. And so there's enough locations out there, and you add up all the locations by each company. That's why I'm saying it can go to 5 million barrels and go to 10 million barrels. The Eagle Ford and the Bakken have lots of opportunities, and they'll start growing again from a lower base. But their inventory is not as deep as the Permian. So the Permian is going to eventually supply 50% of, in my opinion, U.S. crude. It's been normally supplying around 20 to 25%. It's going to move higher and higher over time. And that's why everybody is focused on the Permian. And so the Bakken and the Eagle Ford will start growing again at 55 to 60. The question we get asked from investors is that when it gets to 70, should we grow at 20%, 25? Should we take the excess cash flow and pay it back as a dividend? Should we just stay at 15 to 20%? And so most investors in the U.S. don't want you to chase the growth curve like we did before, because we all know what's going to happen 2 years, 3 years down the road. The price is going to fall again. And the people with the best balance sheets who do the best hedging are the survivors. And so there is an opportunity to get up to $1 million, $1.5 million again. But it really can't grow that long at that type of pace. You got to have too high of oil price. And to me, it's going to collapse again, and we'll see $20, $30, $40 again. And that's what's going to slow it down. And people are going to be afraid. They're going to run with better balance sheets. I think they're going to do more hedging in the next cycle. But the big unknown, how fast does the oil and gas independence push the growth? So do people start pushing it 20, 25, 30 again? That's unknown. So it depends on what the stock market and what investors do with their stocks. So
I'd like to add something on this one.
Is that sustainable for 10 years or 15 years?
Oh, I see.
20 years?
The Permian can grow 300,000 barrels a day for 10 years, easy. The Bakken, the Eagle Ford, and the Stack. The Eagle Ford got up to 1.7. I think it'd have to be, it's down to below 1 million. I think it would be hard to get back up to 1.5 million. I saw John in the background. I'm not an expert on the Bakken. He may have left. John Hess, you still here? But the Bakken went from 1.25 down to 950,000 barrels a day, and it probably might be able to get back to maybe a couple 100,000. So you got to realize the Eagle Ford may only grow 500,000 total. The Bakken may be 200,000-300,000 the most. So it's small. So really, it's only the Permian the world or OPEC should focus on as the only really long-term viable entity that could grow. And it could grow at 300,000 a year, or it could grow at maybe 500,000 a year.
Now, I just wanted to add something for the long term. As the people said before, so recovery is a difficult term to explain in this. It's very low. In the last few years, people have done refracking. And you have example when you refrac where you produce more than the first time. Now imagine the thousands and thousands of wells that we have in the US with very few stages. In fact, people have refracted with the same stages and improved dramatically the production. There is a huge amount of oil and gas here, which we don't fully understand how we produce, but we do produce it. And as we go, we'll understand it better, and I think we'll become really good at it. So, one thing that it did, certainly, it killed once and for good the peak oil story, because hydrocarbons are here, and we will get them out.
To that point, I think if you think of the recovery factors that we still have in these wells, you're still at best 30%. So many in cases lower than that. So there's a lot that we can do. Some of these wells have been producing since the 60s, 50s.
Will Davey, Precision Impulse. So absolutely fascinating numbers and perspective from three key organizations in unconventional hydrocarbon. I'm struck by the United States supply and demand picture leading to massive import dependency and provoking a US upstream revolution. What would China need to do to encourage your organizations to replicate the same revolution with Chinese unconventional?
I maybe just give some aspects that were mentioned already relative to the infrastructure. And again, as you look at the rock, there is opportunity within China. When you think about fracturing, though, there's the need for the water and having that infrastructure to be able to utilize the water. There's been some successes, but there's still more that needs to be developed from an infrastructure. And then also, as you look at the regulatory front, there it's really national and it's owned by the country. How do you develop smaller independents versus the big state-owned companies? Some of that needs to develop as well.
We have had probably the most successful joint venture with the Chinese in the Permian Basin. So we have a joint venture with Sinochem. So they're investing 40% with us in the southern part of our Spraberry Wolfcamp field. We have no rigs running there in that portion of the play today. We'll be most likely adding rigs next year, but they've had a chance for 3 years to observe our practices, our culture. The big question is whether or not what they do with it in China and elsewhere, and I don't have a feel for that. Whether or not they're taking their lessons learned and trying to create that inside Sinochem in Beijing, I don't know.
I think the biggest issue that they have is probably the infrastructure, as you said, because the field they have, at least the one I know, are quite far away from everything. They don't have water, they don't have infrastructure, they don't have electricity. So it's a big infrastructure. So it will drive the cost up. It's not like, Midland, it's an easy place, Oil has been there forever, almost.
Javier Blas from Bloomberg News. My question is for Scott. This year, the equity market has been quite important for Pioneer and others in the E&P industry in the US. What are your views of the openness of the equity market for 2017? What is the appetite of investors you see there in equity and also on the debt market? You think that shale companies are going to be able to tap the debt market? Thank you.
Yes, I think it was mentioned this morning. There's been over $40 billion raised in equity, roughly 15 last year and about $28 billion this year. A lot of that's gone in the Permian Basin. There's been less on the debt market side because people in our industry have too much debt. And so the equity markets is their window. We had our first IPO since 2014. It was a Rockies-based company in the DJ Basin outside of Denver. That went with success just in the last couple of weeks. So the equity markets are open. Investors feel like that we'll see $60, $65 by 2018. And the key is whether or not we see that. And so it all depends on the success of this OPEC meeting at the end of November, and then whether or not, you heard this morning, I guess they asked the audience whether or not any cheating will occur. I think 90% of the people raised their hand this morning. After that, so it depends on there's still a lot of projects coming on next year from investments around the world at a $100 price environment. So 2017 is sort of your last year for projects from the past 7-8 year investment. And so as long as the price holds, the equity markets will be strong in the US and people will continue to go to the equity markets and the debt markets in 2017.
Well, with that, we're going to wrap up our panel. So thank you very much for the discussion, and thank you, everyone.
Thank you. Good job, Lorenzo.